Good evening, everyone. Thanks so much for being here. My name is Angela Baker, and I'm the business librarian here at the Mount Prospect Public Library. And part of my job as the business librarian is to make sure our patrons have access to excellent financial information to help them make those important decisions, which is why I'm so delighted that Karen Chan is here. She's always a wealth of information for us, Okay. Karen Chan has been educating the public about financial topics for more than 30 years. You just said 33 years. Previously, she served as consumer economics educator with the University of Illinois Extension. She is a certified financial planner emeritus and a perennial favorite presenter for all kinds of financial literacy programs at libraries and community centers across the Chicagoland area. I'm always delighted when she's here. Karen, welcome. Please welcome Karen.
It's always my pleasure to be at any library, but particularly here with Angela and with Mount Prospect. As I came in tonight, the lady who's sitting at the desk out there remembered, and I don't think she said exactly how many years ago, but back when I was still with Extension, probably fairly early on, she was talking about me having done a Social Security workshop that she coordinated way back then. So, yeah. You know, I don't know who said it, but, you know, if you love what you do, you'll never work a day in your life. I'm very much, except for when I was with Extension, of course, you had all the administrative and paperwork and blah, 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 you know. But as far as this part, yeah, never worked a day in my life. So, a year ago, to be honest, when we started dealing with tariffs and the uncertainty about prices and what was going to happen, I decided maybe I should have a program something like this available, and here we are a year and a half later, and the reality is that financial things are always uncertain. We just feel the uncertainty more, I guess, at some points than others, but at any rate, we're going to talk about a whole range of things tonight. They may not seem related, but they all tie into the idea of how do we deal with uncertainty as far as our finances go. And Angela already gave me a lovely intro, so we will skip that. I'm going to be pointing you to a number of websites, publications, so forth. Many of them you're going to find at this location on my website. So this is just Karen. I guess you can't even see the URL. The URL is on the last page of your handout, just so you know. And once you get to the website, if you go to resources and then go all the way down to 12 months to take charge of your finances, I know that's not the class you're here for, but a lot of the things I want you to use are the same. And so that'll be a good place for you to start to go look for some of the things I tell you about tonight. The other place will be another page on my site called Finding Financial Assistance. And this is where you'll find links to government support programs and things like that. All right, so here's the order that we're going to run through things tonight. I hope we aren't really going to feel like we're running, but we will move expeditiously. We're going to talk about about managing expenses and what to do, what creditors can do when you don't pay, and what you should do when you can't pay. We're going to talk about ways to actually find cash, how to look at different income sources. We're going to talk about whether the pros and cons of looking to your retirement plan as a source of dollars if you aren't yet at the point where you really ought to be using it. A couple of comments about layoff situations, and then we'll finish up with just a little bit about investing in uncertain times. So, kind of off in a different track, just to get started. Not too many years ago, this label started being used where we talk about financial shocks. And the first time I heard it, I was kind of like, what? And then as I was working on this program, I thought, no, that's really an apt description. We experience shocks of many different kinds. And financial shocks are one of them, where certainly a layoff is a financial shock. Buying gas might have been your financial shock, over the last couple of months. But when you do go through some sort of an upheaval in your financial life, it's like any other trauma. It makes you, to a certain extent, it short circuits your brain. You will not make decisions as thoughtfully or as carefully or in the same way that you would have when you weren't experiencing this trauma. And so I just want you to recognize that it's easy to feel overwhelmed. It also makes you more vulnerable to frauds and scammers. So if you are feeling stressed about finances or anything else, just be aware that it makes you more vulnerable. And so you actually need to be extra careful about thinking about clicking that link or answering, responding to questions on the phone or what have you. And it's always wise to try to be as kind to yourself as you would be to someone else going through what you're going through. I had someone say to me once when I was kind of beating myself up about, well, I should be able to do this, and I should be able to, and she's like, if you had a friend in your situation, what would you expect of them? And I was like, well, I wouldn't really expect them to do those things. She says, then don't be so hard on yourself either. So learning to be kind to ourselves a bit. Okay. You may be at a point where you need to use strategies to deal with current issues that you're having, or you may be coming here sort of preemptively. Let me get ready in case. And if you're here in that role, what should I do if? How can I get ready? The advantage I see of your being here is, if a bad thing happens, if you already have a plan about what you're going to do if something happens, you can react more quickly. You will be able to make better decisions because you already made the decisions when things were calm. And research has shown that when people go through a financial shock, when they have to reduce spending, it takes most households 6 months to adapt to that new reality. You can dig yourself into a pretty deep financial hole in 6 months, like if one of a couple got laid off and you're still spending like you were when both were employed. So having a plan that lets you react faster means that your hole will be smaller and easier to get out of, when the time comes. All right, so whenever we talk about managing anything about our finances, we kind of always have to start in the same place. And that is, you can't figure out what to do about anything until you know where you are right now. And where you are right now is, where does your money go? How much are you spending right now? Now, one option to figure out where your money goes is the gold standard of tracking your expenses. I don't care what tool you use, whether it's pen and paper or a phone app or you're an Excel spreadsheet person or whatever, but tracking your expenses for at least 1 month, preferably for 3, so that you actually get a pretty clear picture of your patterns. That's option 1, like I said, the gold standard. But option two is sort of the shortcut, because nowadays most of our spending leaves a trail. It leaves cookies. I shouldn't use that because that's a bad connotation now in computer stuff. It leaves a trail. It leaves a digital trail for most of us. And so you can probably get a kind of a jump start by just looking back. This is early in June, so you might say, well, I'm going to look back at April and May, and I'm going to reconstruct where my money went. You're going to look at your credit card statement, your bank statement, look for those cash withdrawals that you took, figure out where that went, and reconstruct where your money went for the last 2 months. Now, you won't get everything, but it'll be close enough that you'll be able to go the next step, which will be making a plan based on what you saw. Now, because you're not tracking expenses or looking back for an entire year, you're going to miss some things. So consciously ask yourself, go through the year in your mind. January, what things happened in January that I need to remember? Oh, we're fulfilling deductibles on our health care expenses, so put down an extra $300 there. Maybe you pay your property taxes directly instead of having it escrowed. That means you get a big bill in June and September, is that right? Memberships, things like that. Make sure to capture those because they may not happen in the months that you're looking at. And guesstimate the things that you can't anticipate. Like, how much do you think you might spend on home repairs? Do you think you might have to replace an appliance? How often does the dog go to the vet? And if you've got a kid that plays sports, then how often do they end up in the emergency room? Try to kind of guesstimate those so that you come up with a pretty complete picture. And then make a plan based on that spending history. Once you've made the plan, you're not done though. Then you need to continue tracking your expenses so you can compare what really happens with what you thought was going to happen or what you intended to happen. And that's what I like about this, this form here. This is actually from one of the tools that's on the 12 months to take charge of your finances page. There's actually an interactive version where you make your plan and you can see how much do you think you're going to spend monthly on each of these things, how much annually. Then you put in what did you actually spend, and then what was the difference and what's your new planned amount. Your plan will never happen. Your spending will never follow your plan exactly because this is real life, right? I want to tell you a little story here that drove that home to me. So when I was with U of I Extension, we did a lot of train-the-trainer classes for individuals who work in, like in social services or like Catholic charities or township offices, where they're working with people who have financial difficulties. And we had a curriculum called All My Money that was to help them work with their clients on money management skills. So we taught envelope budgeting, where you have envelopes. In the old days when you got paid cash or you cashed your check, you know, you would label envelopes with categories of spending. You'd actually put the money in the envelope. And it's actually a lovely concrete way of keeping track of whether you still have any money to spend or not. When the envelope's empty, you don't have any more money for that this month. Anyway, so we weren't expecting them to do their whole life in envelope budgeting, but we asked them to choose 3 categories of expenses, preferably the ones that they either spent cash or used a debit card for, and to keep track of those. And so the next week they came back and I said, so how'd it go? And one lady spoke up and she said, it didn't work. I'm like, that wasn't one of the answers I thought I was going to hear, so tell me about it. So what were your categories? She said one was groceries, and she had $100 in there, and this was for the week, so they could see how they did for the week. Another envelope was for lunch at work. She typically went out to eat on Friday, and so she had put $25 or whatever it was into that envelope. And I don't remember what the third one was, but it doesn't come into play, so it doesn't matter. And I was like, okay, so what happened? She says, well, Friday I went out to lunch and I used the money in my envelope. And then Monday I'm going to go to the grocery store after work, so I've got my grocery envelope with me. But I get to work and they say, it's Jorge's birthday and we have to take him out to lunch today and your share will be so much. Well, that wasn't in the budget. And I said, well, what did you do? She said, well, I took it out of the grocery envelope. I mean, what could I do? We can't not celebrate Jorge's birthday. And I was like, okay, so what happened when you went to the grocery store? And she said, well, you know, I didn't have $100 anymore. I had whatever, 70. And she said, it wasn't easy, but I looked for less expensive ones and could I substitute this? And I had to put something back. But she says, I got out of there with $70. And I said, you know what? It worked. Because the point of a plan is not that everything goes the way you think it is. It enables you to make good decisions in real time because you know where you are. Okay? So, pardon me for going off on a story, but for me, even having taught it for a long time already at that point, her story just told me what it was all about, you know, why we do this. Okay, so there are probably literally 1 million people online who want to tell you how to reduce your spending. So I'm not going to attempt to tell you all the ways to reduce your spending, but just give you a few ideas to maybe get your own brain kind of clicking on this. If you live in a household of more than one person, try to make this a household affair or a family affair, that it's not just you doing this. Try to get everybody involved, get them to buy in. I know families with kids who have done, they'll announce, we're going to have a buy nothing week, kind of like a little competition. Can we get through this week without spending any money? I mean, other than paying the bills, you know, because we don't want the electricity to have a late fee or get shut off or any of that stuff. You can also look for ways to pay nothing. For example, did you have to pay a registration fee to be here tonight? No, because You can do all kinds of things with your library without having to pay for those individual services. Food banks are sort of the best example of a way you can get something that you and your family need with no money out of pocket. And do any of you belong to a Buy Nothing group in your neighborhood? No, not a single. Oh, I see one. Good. Oh, two. Okay, good. There's different groups that do this. There's Free Cycle, and there are others. Buy Nothing happens to be the one that I'm familiar with. It follows guidelines set at the national level, but they operate on a local basis. So like in Lisle, we have a Buy Nothing group. And the way it works is you have something that you no longer need. You take a picture and you post it and said, gifting this. And you let people say if they could use it. And if so, you arrange for pickup. And if you need something, you can place an in search of post where it says, I need this, and I actually need it by Friday. Like a lady today said she ordered, that she's obviously got a graduation party that she's doing, and she had ordered like a hot dog thing, that cooks the hot dogs and people come by and pick up their hot dog, and it didn't come. And so she's like, does anybody have something I can use, to cook hot dogs for this thing tomorrow? And somebody came through for her. That was a loan. It wasn't actually a gift. So there are things like that where you can benefit from being part of a community. Thrifting, I have a niece who is a master. She thrifted the dress she wore at her wedding, and it was gorgeous. Now, grocery shopping, we often talk about groceries when we're trying to save money, and here's why. It's one of the most flexible expenses we have. It's a necessity, right? But you can walk in the store and say, I need protein for dinner tonight. And you can buy anything from beans to beef tenderloin. Okay, that's a wide range of cost. So, and if you make changes to your grocery expenses, you feel the impact right away. You don't wait until you get the next electric bill to see the impact of the fact that you reduced your electricity use or something. But with grocery shopping today, it's really about reading the ad, making a list, that's always been the case, and comparing brands and sizes. Don't assume that the thing that's on the end cap at the end of the aisle are the sale items. It may be the same kind of product, but the one that's on sale may actually be in the regular place, and you got to go look for it. So, and using the app nowadays, I'm sorry to say, I resisted for a long time, and the day I read Consumer Reports saying, if you're going to get the best prices on your groceries, you've got to use your grocery store's app. Unless you have a grocery store that doesn't have an app, I have one of those in my neighborhood, and I spend 50% of my grocery dollars there. I never miss clipping a coupon because there aren't coupons, so I always pay the price I expect when I go to that store. The other one, I have to be careful. Oh, I missed that coupon. Can you stop ringing up for a second while I clip this? And anyway, okay. Also, watch for habits, your usual ways of doing things that you've developed over the years, which may or may not be the most economical ways of doing things. I had a coworker at one point where almost every day she showed up with fast food breakfast that she ate at her desk. Well, first I was ticked off because she wasn't really working if she was sitting there eating her breakfast every day. That's a different story. But I'm sorry, I can have a bowl of cereal at home that costs very little, and how much did you spend for that at the drive-thru? So we all have habits that may be helpful because we don't have to think about how we're doing things, but we ought to think about them again and remind ourselves, is that the way I should be doing it now? Maybe I need to change some of these things. And review all of your bills. Like when you're going back and tracking your expenses, it's a good time to look very carefully at each credit card bill, to look carefully at your bank statement, because you may notice things that's like, oh, I thought I canceled that subscription. Or, oh, I didn't realize that was costing that much. So it will help you remain aware of what things are actually costing. The one downside of having bills paid electronically is we don't even have to look at the bills. But we should look at the bills, at least periodically, to make sure that we really know what's on there. All righty, now, I hope that you won't be in this situation, but the reality is that most of us at some point in our life will come to a situation where I can't pay everything. What do we do? Well, let's first of all talk about what the lender can do to you if you don't pay. So, and a lot of this has to do with credit cards, but some of these apply to other things as well. First of all, whatever you're late on, whether it's your electric bill, your credit card bill, or whatever, you're probably going to get hit with a late fee. The amount depends on the company you're dealing with. If you had some sort of a promotional interest rate, like on a new credit card, you will lose the promotional interest rate if you don't make the payments on time. Once you're 30 days late, the lender can report you, or the utility, whoever it is, can report you on your credit report so that it will start showing up as you were late on your credit report, which hurts your credit score, which in turn will cost you more money in other ways. Once you hit 60 days late, when we're thinking about credit cards, at that point they can start making you pay the penalty interest rate. Believe it or not, even higher than the rate that you normally pay. Beyond that, the lender's options might be to turn this over to a collection agency, either having somebody collect on their behalf or actually selling the debt to another bill collector who will buy the debt and then pursue you until they get something out of you. There are situations where a debt that you have, the payments could start coming out of your paycheck. The first one is wage assignment. This only happens when you signed a contract that somewhere in that contract you agreed that if you don't pay, you've given them permission to go to your employer and get it out of your paycheck. That's called wage assignment. Now the good news is that that's a right that you waived in the contract, but there'll be instructions in the contract about how to revoke that decision as well. So you can normally reverse a wage assignment if you know that you can, and you go look in the contract for how to do it. The second way, though, that payments will come out of your paycheck is where they literally go to court, and that's a wage garnishment. And once the court says that they can take money out of your paycheck, that's done. So if you ever get a notice about being in court because of a potential wage garnishment, go. Because if you don't go, it's automatic. The lender gets what they want, okay? You need to be there to say, no, because, I mean, the court does have guidelines. There are amounts that they will not allow to be garnished because they recognize that you have to have food and you need housing and so forth. But wage garnishment, it's good because the court has to approve it. It's bad because once the court says it's done, it's done. Depending on whether the debt that we're talking about, whether there was collateral against the debt, like when you get a car loan, your car is the collateral against the car loan. When you buy a house, your house is the collateral for the mortgage. In those cases, those items can be taken if you don't pay. That's why you hear about car repossessions, because the car was collateral on the loan. That's why you hear about home foreclosures, because the mortgage was basically the guarantee on that debt. Another thing that you may not know about is that for only certain kinds of debts, but there are certain things where if you owe them and you're expecting an income tax refund, you won't get the refund because the government will take that to pay either defaulted student loans, past due child support, or state and federal tax debt. It's not just any debt, it's only those that would be taken from your tax refund. Now, so that's what the lenders can do. What should you do? First, before you start getting so rattled with the phone calls that all you want to do is pay this one that's calling you 10 times a day, no, calm yourself down, or at least ignore that phone call and say, of the things that I need to pay, which are the most important for my family? And one of them might be paying the rent so you don't get evicted. One of them might be paying the electric bill so you can still cook food and stay warm. So you decide which of the things that are most important And the ones that aren't the top priorities are the ones that you may choose not to pay. And here's one thing not to do. This isn't on here, but I've known people who do this. They want to be fair, right? And so they pay everybody something. On the surface, it sounds like you're being an honorable person, you're doing the best you can. The reality is, pardon my language, but you just screwed yourself, because those partial payments basically are like no payment, nobody's happy, and everybody reports you to the credit bureau, and now you got late fees from everybody. So don't do that, okay? Don't give everybody a little bit. Pay the ones you can pay that are most important, and the others, call. We'll get to that on the next page. Let's see, what else I was going to say on here. And as we just talked about what the lenders can do when you don't pay, think about what any particular lender would do, like credit cards. Credit cards, okay, it used to be that Discover actually said, back when they were Sears card, that what you bought on the card was security on that debt, and theoretically, if you bought a TV at Sears and used the credit card and didn't pay it, theoretically, they couldn't take your TV. But in general, credit cards are not secured debt. They can come after you for the money, but they cannot come take your stuff. And so sometimes credit cards end up being in the category of, I want to pay them, but it's not as important as these other things. And also recognize that if you should eventually go become bankrupt, it's good to know what things cannot be resolved in bankruptcy. And the short list is child support cannot be settled in bankruptcy, taxes cannot be resolved in bankruptcy, and federal student loans can't be discharged in bankruptcy. So those are things where you're going to end up paying them somewhere, somehow. And so they might, because of that, become one of your priorities, knowing that they're not going to go away. If you cannot pay, call. And let me finish this thought, and I'll come back to you. Figure out how much you think you can pay, even if it's nothing. Know what you think is actually doable. Call them right away. Don't wait until you're late. If the bill's not due until next week, but you already know you can't pay it, call them today. They will be more willing to work with you if your account is still current. Be prepared to negotiate. Each lender is going to be different. One might say, well, we'll give you a pass on this month's payment. Another one might say, well, we'll give you a break on the interest rate for the next 3 months. Another one might offer something else. You won't know until you talk to them what they are willing to do. But be prepared to negotiate. And one of the things you can always ask is that they do not report you to the credit bureaus. You can ask for that. You can ask them to waive late fees, especially if you've been a good customer up to that point. Take notes about what they agreed to, ask if they'll send it to you in writing, and then try to follow through, because calling and asking for a second chance often doesn't happen. So I'm going to take this gentleman's question, but I also want to point out, for the most part, unless it's clarification, I'll take questions at the end, and I'll stay after for that specific purpose. Yes, sir.
So, of all the bills that we've ever gotten, mortgage, the car bills, the credit cards, none of them, except the medical bills, always say, if you can't pay this, they're always saying, if you can't pay it, call them, and
Okay,
something on the bill about
so
all
he's
those bills.
he's pointing out that oftentimes on the bill, it actually gives you instructions like to call or what to do if you're unable to pay. And it's good to look for those notices on there.
It's not on any other bills, just the health bills.
We'll talk about that in a minute. Okay. There are places to get help with both managing money and negotiating with creditors. For credit counseling, your go-to place is the National Foundation for Consumer Credit. They are an umbrella organization that almost all of your reputable nonprofit credit counseling organizations belong to. And so if you go to them, you'll either get funneled to, if there's a local group where you can meet with somebody in person, or they'll hook you up with somebody that you'll work with by phone. The advantage is that they often already have agreements with, like, credit card XYZ. They already have an agreement with them that if somebody comes in and enrolls with them in a debt management program, you automatically get no payments for 3 months, or you get no reporting to the credit reporting agency, or you get reduced interest. They'll have that already set up, and you don't have to work with each lender yourself to try to work those things out. So, another piece of knowing what to do is knowing what your debts are. If you don't know exactly who you owe and how much, that in and of itself is probably a signal that this is an important thing for you to do. Listing all of your creditors, how much you owe, what the interest rate is, so on and so forth. And this is a form that I actually put on my webpage for you on the 12 months to take charge of your finances page. Once you've got that list, here's something you could do with it. There's, so I told you that I worked for University of Illinois Extension. Every state has a land-grant university. Every land-grant university has an extension service. And Utah's created this called PowerPay. It's a tool to help you figure out how to get yourself out of debt. You enter your information, no personal information, no name, no account numbers. You just put in some sort of a name for that creditor. You put in your balance, the payment that you've been making, the interest rate, and it'll tell you how long it'll take to pay off. Now, ignore the dates, because I did this example a long time ago, but pay attention to how long. So this, what I called Maxter credit card, it was going to take me 5 months to pay that off. The VIP card, going to take me 5 years and 9 months, 2 years and 5 months to pay this one. The car loan, 11 months. It shows you, if you continue paying at the rate you are, how long will it take to pay these off? But then it will recalculate if you tell it something like, maybe this is June, maybe you haven't used all of your tax refund yet. You still got $100. And so you tell PowerPay, well, how about if I put $100 toward that Maxter card? I can just pay that whole thing. And PowerPay will say, okay. And then once you've done that, instead of saying, oh, great, now I've got an extra $25 a month, I can go out to dinner one night. No. PowerPay is going to say, take that $25 and you decide which of these other debts you're going to apply that to every month so you can pay your debts faster. And you choose one of two ways. You either want to apply it to the debt that has the highest interest rate or the next one that you could pay off the fastest. Now, I've actually done trials to see which one works out best. Sometimes, only to a small extent, by working on the bill that has the highest interest rate, it may save you more money in the long haul, but we're emotional beings. And our brains really, really live for rewards. And if your brain gets to experience paying off a bill sooner rather than later, your brain is very happy. And your brain will say, let's do that again. Let's attack the next one. And so you're probably more likely to keep working at this and paying down debt if you do attack the bill you can pay off the soonest instead of the one with the highest interest rate. But PowerPay is a great tool. There's no charge. It's online. Pardon me. Sorry to the recording. There's also an Apple phone, an iPhone version app for this as well. Okay, medical debt. Medical debt is unique in many ways. A lot of our hospitals, not all, but a lot of them are still nonprofits, and that shows through in certain ways. But healthcare providers are generally more apt to work with you when you say, I don't have that much money today, what can we do? They are more apt to negotiate a lower amount. Maybe they have an office that actually provides financial assistance in certain situations. They may have a social worker, actually, who can work with you on this stuff. And their interest rate may be less than many of your other debts. The other thing that you may not know about medical debt is it hurts your credit history less, or it's less likely to hurt it at all. Credit reporting agencies have generally agreed that if you have owed medical debt for less than 12 months, they do not consider it in your credit score and it doesn't show up on your credit report. Not until you've owed it for 12 months. Also, once it's paid, it disappears completely. Most things that you were late on, even after you pay them, it still shows how many times you were late, but not on medical bills. It just goes away. And even if it goes to collections, if the amount is less than $500, the credit reporting agencies still don't reflect it in your credit score. So medical debt hurts you less. Moral of that story is, if you owe the hospital, you owe your physician, don't use a credit card to pay that debt. Your credit card is going to hurt your credit score. It's got a higher interest rate. They're not going to negotiate. Leave medical debt as medical debt and do the best you can to work with the provider, because they are more likely to work with you than many others. So you don't want to take medical debt and turn it into credit card debt.
I just wanted to share Endeavor, that system, healthcare system, is very generous with
Okay, so she's given an example, I'm saying this for the recording, she's given an example of Endeavor Hospital Group as being a good one to find ways to help families with low to moderate incomes. We'll put that label on it, because that's not necessarily low income.
I usually think you have to be on at that
Yeah,
level of
yeah.
American Health.
And that,
For sure, call anybody using
yeah,
that system.
and I've had this same comment come up in other classes on this, where they give an example of personal knowledge about a particular one. I'm going to take this, and then we're going to hold the rest till the end.
Regarding to get financial aid, you need something to
Yeah, you sent in like the tax form from last year.
Yeah. Almost any time you're applying for something that's need-based, you're going to have pay stubs, tax forms, what have you. Yep. Alrighty. So, how about finding ways to free up some of your monthly income so that you can use it to pay some bills that you're having a hard time with? We'll call this found money. It's not as... I used to work with a couple of ladies this is back in the day when we all used cash for everything. Didn't matter where we went, like for lunch or to a meeting or whatever, when they got out of the car, one of them would always say, "Look for money, look for money." And if you looked for it, back then, if you looked for it, you often found some. They would also check on payphones, to see if there was change in the payphones. So that's one version of found money. This is a slightly different version, because you're not probably going to find enough those ways to help out very much. But maybe there's some found money, or I should maybe, like I said, freeing up some of your income so that you can use it for other things. That example of paying off one debt and getting rid of that monthly payment, it did mean that you freed up, in that example, $25. Now, I was encouraging you to use that to pay another debt, to pay it down faster, but maybe you're not at that point to have that luxury. Maybe that $25 needs to go on, the electric bill. It's not a debt yet, but it's going to be if I can't pay it. But paying off one debt does give you more flexibility with your monthly income. Another way to free up and reduce a bill perhaps is, while your credit is still good, reduce your credit card payments perhaps. If you have a credit card where you are paying interest, look for one of those 0% credit card offers, hopefully with no transfer fee, and get yourself a few months without interest, and try to use that opportunity to either pay debt down or to have a lower monthly payment so that you can manage some of the other things you're having trouble with. Another idea is there are some people there are some financial professionals who don't want anybody to end up getting a big tax refund, because they say that meant you gave the government an interest-free loan, and you don't want to do that. You want the money in your pocket. Well, I understand that a lot of households use over-withholding to get a large refund as a sort of way of forced savings, so that when you get this lump sum, you know what you're going to do with it. That's the family vacation for the summer, maybe. Maybe it's some other thing you've been building toward. I'm okay with that. But when money's tight, you might want to say, when is it better for me to have that money? Is it better for me not to wait until next March and get the $1,500 then? Or would it be better if I had an extra $125 a month right now to pay the things I need to pay? And if you decide having it now is better, then you need to do a new W-4 with your employer or with Social Security, and change the amount that's being withheld so that you get more of your income in hand instead of being withheld for taxes. But don't overdo it because you don't want to end up owing a penalty next year. Okay. Now, this list is in the same idea, but these are the things where I don't want you to do these unless you have no choice, because there are prices to pay for these. First is paying just the minimum on a credit card. Maybe you're somebody who you never paid it off every month, but you always paid a lot more than the minimum. Well, if that right now means you can't pay another bill, maybe for a few months, maybe you pay just the minimum, recognizing that you're going to pay more interest, but it will let you keep current on other bills. Now, if you're somebody who has always paid in full every month, at all costs don't do this, because you can't pay off one month and then not pay off the next month. You'll end up paying interest every month. You got to pay it in full every month in order to truly pay no interest. So if you're somebody who pays in full every month, do your darndest to keep that up. Another thing that's kind of a last resort in my book is if you are working and you contribute to a retirement plan at work, first of all, you may be getting matching money on that, which means you're like getting a return on it right away. But if you're desperate to have more dollars to pay bills with, you might think about reducing the amount that you're contributing to your employer plan or stopping it altogether. Now, here's something, though, to recognize. You're not going to get, your paycheck will not increase by the amount that you reduced your contribution by because of taxes. Because right now, let's say you're putting $100 a month into your retirement account, and it's going into a traditional account, it's not a Roth. And so that $100, you're not paying tax on it now. You'll pay tax on it later on when you take it out, presumably in retirement. So you cancel that. You stop contributing the $100 a month, and you're thinking your paycheck's going to go up by $100. No, because now the taxable income in your check just increased, and so you're going to see more tax taken out. And so instead of a $100 increase in your paycheck, you might see an $80 increase. Okay, so just don't expect to see every dollar equal to what you reduced your retirement plan contribution by. Now, there's several things to know about retirement plans. I'm going to cover some here, and then later on we'll finish the rest. If your plan does do a match, that's very valuable, especially if you've been with the employer long enough that you're vested, meaning that you own all of that matching money, or maybe you're very close to being vested. If you've only been at the company for a year or two and you're not sure you ever will be vested, then the matching doesn't seem so important. But the other thing to know is that if you're likely to need money from your retirement plan, and your choice really is either to stop contributing or to try to take money out of the plan while you're still working, stopping contributing is probably the better of the two. Many plans don't even allow you to take money out while you're still employed. That's called an in-service distribution. Some plans don't even allow it. And if it does, you will probably end up owing not only tax on the money that you took out, but also a 10% penalty if you're not yet age 59 and a half. Okay, now, this doesn't really fit with the idea that this is somebody who is struggling to pay the bills, but I wanted to include this. Somebody who's been laid off, somebody whose hours have been cut, somebody whose spouse has just retired and your household income has gone down significantly. It means that you're going to have lower income for this year. You're probably going to be in a lower tax bracket. And it means that if you do make that contribution to your retirement plan, your tax rate is going to be low enough that you're not getting much of a tax break by contributing to that traditional plan. If your plan offers a Roth version, which doesn't give you a tax break now, but it means all the earnings will be tax-free down the road, you might decide to switch. I'm still going to put some money in my retirement plan, but I'm going to put it in the Roth because I'm not really going to get much of any of a tax break now by putting it in the traditional side of the plan. And then that idea on steroids is that money that you already have in a traditional retirement plan that you have access to, so probably not still working, while you're in these lower tax brackets because of retirement or what have you, those are years to think about, maybe I should convert some of the money in my traditional retirement plan to a Roth account while I'm in the 10% tax bracket, for example, instead of the 22% tax bracket. That's a little more strategic. That takes a little more close calculation to make sure that it's going to turn out well for you. But these are things to think about. Okay, now, when you've done these things, trying to free up some of your monthly income so you can use it for debts or to save up for when you think things are going to be really rough in a couple of months, maybe you want to have that money deposited into a special account at the bank so it's not easy for you to get your hands on. Maybe you want to split your paycheck between your checking account and your savings account now so that you don't just sort of lose track of that extra $80 in your paycheck that you got by stopping your retirement plan contribution. And so you could put that money into a savings account. You could put it in a very short-term certificate of deposit, like 3 months. If you have a fair amount of money that you want to make sure you can access some of it at any time, you might do CDs with staggered maturities. So you might put some money in a 3-month CD, and some of it in a 6-month CD, and some in a 9-month, and some in a 10-month, in a year. And if you don't end up needing the money when it comes to maturity, you roll it over into a year CD or a 5-year CD so that every month, every 3 months or every year, you have access to some money without very much penalty, if any, for accessing the money, but you're presumably getting better interest rates. That's a little involved. So let me just say this. Historically, not so much the last few years, historically, if you put your money into a CD with the bank, the longer the term of the CD, the higher the interest rate was. They were rewarding you for locking your money up for longer. For the last, 6 years or so, that hasn't really been the case. Ironically, you could get higher rates on a 12-month CD or a 13-month CD than you could a 4 or 5-year one. Not the way things normally work. But just a heads up that if you are going to put money into a CD, shop around for rates. Don't just automatically do it with your bank. Check online banks, check other banks in the community, make sure you're getting the best rate. All right. These are bigger things for generating cash. Things like filing for Social Security if you're eligible but you haven't already, or if you have a pension that you've been waiting to start claiming, whether you wanted to do that. But also to think about, a lot of us have some things that we could sell or cash in if needed. I've known people who have savings bonds that they were given when they were born, and they're 45 years old, and the bonds haven't been paying interest for a long time now, and they still got the bonds sitting in the safe at home. It's like, honey, go cash that thing in, and put it somewhere you can get some interest on it. But those are things that, maybe it's only $50, maybe it's a couple $100, but it's been sitting there. Maybe this is a good time to use that. Talk back to certificates of deposit, CDs at the bank, they have a maturity date. If you take money out before the maturity date, you will pay a penalty. And so you want to be aware of what that penalty is before you actually take the money out, maybe even before you open the CD. Some banks have much more punitive early withdrawal penalties than others. Some of you might have whole life insurance policies. Whole life insurance policies are the type that build up cash value over time. That cash value is something that if you end the policy, you'll get the cash value back, or you can borrow against the cash value, leaving your policy intact, but if you died after you've borrowed money, your death benefit would be reduced, by the amount of the loan. But whole life insurance policies can be a source of dollars when we need it like that. A loan is not taxable if you take a loan against your policy. If you cash it in, the IRS will say, okay, how much premiums did you pay on that policy? Are the premiums more than the cash value you got out? Then nothing's taxable. But if the cash value that you got out is more than all the premiums you paid in, that difference will be taxable income. And of course, Yeah, I have nieces and nephews that there was a member of the family that would always give them a few shares of some stock when they graduated from high school or graduated from college. And one of them I know turned around and sold them right away. The other one just let her sit there. I didn't do anything with them. And well, by golly, they're worth a little bit of money now. The thing to know about selling stocks or other capital assets like that is if your income is low this year, maybe, and you're in the 10% or the 12% tax bracket on ordinary income, capital gains, if that's your tax bracket, you actually have zero tax on capital gains. And so that would be a smart time to sell something that when you had regular income, you might have paid 15% tax on those gains. Something to think about. How many of you have, and I'm not trying to put you on the spot, I just want to know how applicable this information is to the group. How many of you have a health savings account or have access to a health savings account? Okay, only a few, so I'm going to go through this quickly, and you guys may know this stuff already. The way health savings accounts work are, first of all, you have to have a high deductible health plan in order to put money into the health savings account. But the health savings account, unlike flexible spending plans, is not use it or lose it. It's your money always. There's no deadline by when you have to take the money out to reimburse yourself for expenses. You could use the debit card they gave you with the account to pay your copay at the doctor's office and your copay at the hospital, or you could pay it out of pocket and just let the money sit in the account, and it doesn't have to be in a savings. Once you reach a certain point, you can invest the money, and you can let it grow over time. And when you need the money, or whether you've decided it's time to start pulling the money out because you want to empty it basically before you die, then all you have to do is look at your receipts for the medical expenses you've paid since you opened that account. You can reimburse yourself for those at any time. It could be the year you incurred the expense. It could be 10 years later. It could be 15 years later. It's okay. So if you've been letting money build up in your health savings account, when you in a situation where you need the cash, this is one of the places to look. There's no tax and no penalty when it comes out, as long as you've got the records to show I'm reimbursing myself for qualified medical expenses. Now, if you take more money out than you had qualified medical expenses, then you're talking about tax and penalty. Once you're age 65, the penalty goes away, but the tax will still be there if you don't have qualified medical expenses to justify the reimbursement. When to claim Social Security is a whole 90-minute presentation in and of itself, but let's say that I've had people, years ago I had a guy in class like this. He was 63, I think, when he was in class. He had been laid off when he was 62, had not planned to file for Social Security at that point in time, but he really didn't have a choice. He couldn't find a job, he needed an income, he went ahead and filed for Social Security. He was eligible. Within a few months, though, he got a job. And so he didn't really need to have filed for Social Security, but he needed to at the time. So this is a big decision. Just so you know the basic rules. If you claim early, you will get a lower benefit, end of story. And that lower benefit is locked in for the remainder of your life. For workers, you can claim as early as age 62, but your full retirement age is when you will get the full amount that's shown on the statements you get. Taking Social Security at 62 means you'll get between 70 and 75% of the amount you would have gotten at full retirement age. If you can delay all the way until age 70, you'll get 132% of what that full retirement age benefit was. So it's a big decision. Do I take it now? And by the way, it's not you don't have to wait a whole year. It's month by month. Every month that you delay filing for Social Security, there's a small increase in the benefit that you'll get. Spousal benefits, you can file as early as age 62, but your spouse must have already filed in order for you to get a spousal benefit. Spousal benefits max out at full retirement age, which for you folks here today, your full retirement age is somewhere between 66 and 67, depending on the year of your birth. Survivor benefits, you can claim as early as 60. For someone who's disabled, you could take survivor benefits as early as age 50. Those benefits max out, again, at full retirement age. For whatever reason, full retirement age for survivor benefits can be slightly different, meaning a few months different than regular full retirement age. So you would need to check when your full retirement age for survivor benefits is. Survivors also have a special right where if your spouse is already deceased, you can decide whether to take your own worker benefits first and later switch to the survivor, or you can start with survivor benefits, let your worker benefit increase, and claim it later. And again, that's a more sophisticated calculation, but I just want you to know that that right is there. Okay, retirement plans. Should we or should we not? First of all, and I apologize, this is, heads up, this is the driest and most tedious part of the whole presentation tonight, but it's important for you to know. And if you know some of this, maybe you'll get a little fuller picture, and if you already know the whole thing, then take a nap for 2.5 minutes. Okay, we have 2 different types of retirement accounts. The first is tax deferred, which we also call traditional, meaning that when you put money into the account, you do not pay tax on that part of your income that year. The tax is deferred until presumably you retire, and then you take it out, then you pay the tax. That's why they're called tax deferred. So when you take a distribution from a tax deferred account, you will owe federal tax on that money because it has not been taxed before. Illinois, though, doesn't tax that money. And so you'll owe federal tax, but no Illinois tax. When you take distributions from your tax-deferred account, if it's an employer plan, by law, they will withhold 20% for taxes. Just like there's withholding from your paycheck, they will take withholding from the distribution from your tax-deferred account. And those are 20% withholding. If you're taking it from an IRA, the default is 10%, but you can request it to be more or less than that. Just so you know, if you take a distribution from a tax-deferred account, you aren't necessarily going to see the whole amount. If you take $10,000 out from an employer plan, you'll only see $8,000, okay? Because the rest was withheld. What about Roth accounts? Roth accounts, you did not get any tax break when you put the money in. The tax break comes later on when you are able to take the growth in the account out without any taxes or penalties. And so in a Roth account, you've got at least 2 different pots of money and maybe 3. The pots are, the first one is the contributions, the actual contributions that you put into it. The second pot is the growth in the account. And if you did a Roth conversion from a traditional account to a Roth, those conversions are a third pot of money. When you take money out, the money that comes from contributions, it was already taxed, so there's no tax and no penalty. But the part of the distribution that comes from growth, there will be no tax and no penalty if you meet 2 rules. First, the account has to have been open 5 years, and you have to either be dead, in which case you don't care anymore, disabled, or at least age 59 and a half. Sorry. Finance is not a place where we get to make many jokes, so I apologize for the bad joke. If you have conversions in the account, you already paid tax when you converted, so there's no tax when it comes out. But if you're younger than age 59 and a half, there will be the 10% penalty. So those are your basic rules. Review for some of you, new for some of the rest. You may need to read it 3 times before it sinks in. But here's really what you want to know about. There may not be any penalties. Even these places where I've said 10% penalty, there may not be a penalty if an exception applies in your circumstance. For example, maybe you had high medical expenses. Maybe you became disabled. Maybe you're terminally ill. Maybe you adopted a child. There are we actually now have lots of exceptions that get you out of that 10% penalty. If you want to take a quick read, go to these 2 sites on their IRS website. One of them lists the exceptions that apply to employer plans, and the other one lists the exceptions that apply to IRAs. They overlap, but they are not identical. Okay, now, here's the final and most important thing for you to know. Roth IRAs, it's in red for a purpose. They are special. When you take a distribution from a Roth IRA, not a Roth 401k, not a Roth 403b, a Roth IRA, when you take an IRA, take a distribution from a Roth IRA, the money that comes out first are your contributions. And what do we know about tax when you take the money out? If you take contributions out of a Roth IRA, there's no tax and no penalty because you already paid the tax. So, you need money. You got a Roth IRA. You contributed a total of $12,000 to it over a period of a few years. You could take the whole $12,000 out of the Roth IRA, no tax, no penalty, no problem. I hope you don't have to do that because you'd rather leave it in there to continue growing and getting tax-free growth. But if you need it, this is a way to get it without cost, without taxes, without penalties. I say this to you, but I also want you to keep this in mind if you have children and grandchildren who maybe they're doing gig work. They're not really they're not an employee where they can put money into a retirement plan. They need to know about this because I had a 25-year-old niece. She had some savings. She wasn't sure what to do with it. She's 25. Putting it into a retirement plan that she can't touch for 40 years, not very exciting. A Roth IRA, though, her ears kind of perked up. First of all, she was actually working a volunteer sort of paid job. No income tax. It was a good time for her to put money in a Roth account and know that if she needed money down the road, those contributions would be her backup plan. Hopefully she wouldn't need it, but they would always be a backup plan for her if she needed to lay her hands on some money. Okay, if you're working, you have an employer retirement plan, and you want to get your hands on the money, there are two things you have to look at, what the federal law allows and what your employer's plan allows, and they aren't always the same thing. So loans while you're employed, the federal law allows that, not for IRAs, but for non-IRA plans, but not all plans allow loans. So you have to look at your own employer plan. If it's a loan, you're allowed to pay it back over 5 years. If you used it to get a mortgage to buy a home, then it's a longer time period. If you leave your job, though, and you still have a loan against your 401k, that will become taxable income unless you're able to pay it back within a certain period of time when you leave that company. Another way to access money in an employer plan is hardship distributions. These may be available depending on your plan. They can be available from 401k, 403b, and 457 plans, but these are distributions. They are not loans. You cannot pay it back. And you will be subject to tax and penalty. There's no tax break. The only break here is that they're letting you break into the account and take money out when the employer doesn't really have to let you do that. Another thing to know about retirement accounts, and let me start by saying this. Few people, if anybody, plans to end up in bankruptcy. But people do end up in bankruptcy. You may not really see it coming. It may start where you think, well, this is just a little bad, just a little rough patch here. It'll be okay. But you don't know that for sure. So I want you to look ahead and ask yourself, if I ended up in bankruptcy, how would I feel if I had drained my retirement account trying to make things work, and I get to bankruptcy and realize if I had not taken any money out of my retirement plans, I could keep the money in bankruptcy. It's not taken from you when you file bankruptcy. Employer retirement plans are creditor protected, period, end of story. IRAs, that's federal law. IRAs are protected depending on state law. Illinois does protect IRAs from creditors. It may or may not be as strong as the protection against employer plans. But I just want you to know this because if your bad patch goes on too long, think twice before you raid your retirement account. Because, and this is dead serious here, because you could keep that money even through bankruptcy if you hadn't already taken it out. So that would be, in my view, a serious financial mistake if you took it out and ended up in bankruptcy anyway. So talk to an attorney. That's the last line on here. Okay, so finding assistance. Maybe you need something as simple as you don't have a car anymore. You need a ride to a medical appointment, or you need to know where the closest food bank is, or you heard there's some sort of assistance you can get paying your telephone bill. You don't know where to go. 211. 211. We all know 911, right, for emergencies. This is not for emergencies. This is finding out where you can get help. Depending on which county you live in, 211 might be answered by a county service. It might be answered by one of the nonprofits in your area. But every county in northern Illinois has a functioning 211 number. And they will be able to give you tips about local services, as well as like some of the government programs like SNAP for helping pay for groceries, LIHEAP, that stands for Low Income Heat and Energy Assistance Program. Are you impressed? That helps with gas and electric bills. Now, all of these you have to qualify based on income and assets, but these are government plans that are there to help people. I have links to information about some of these on my website, and this is a short link that will take you to that page where I have links about the government assistance programs. If you might be laid off, there are a couple of quirky things that you might need to know about. First of all, most of us rely on our employer for our health insurance. So if you're losing your job, what happens to your health insurance? First question is, are you married or are you under 26 or younger and your parents have a plan? Can you get on another family member's plan? If you can, losing your job and losing your insurance means you have a window where you can get on their plan. You don't have to wait for open enrollment or any of that stuff. You had a life event that qualifies you to join that other person's plan. If your employer has, I apologize, every rule is different. For some things, it's whether the employer has more than 20 employees, and for others, it's more than 100. I've forgotten the size of the 20, thank you. If your employer has more than 20 employees, they'll be required to offer you COBRA, meaning continuation of your health insurance. But it only lasts for 18 months, and they might choose to pay part of it, but unless the employer chooses to, you will pay the full cost of your health insurance, and you'll find out that it's a lot more expensive than you realized. You do have 60 days to enroll in COBRA after you lose your job. The coverage will be retroactive to the date that you lost coverage, and you can get it not just for yourself, but you can get it for your spouse and dependents as well. Your other options for health insurance, looking at marketplace coverage, not as inexpensive as it may have been in the past, but it means you can get insurance. And then if you're eligible for Medicare, you have certain opportunities to sign up for Medicare without having to wait and without paying any penalty for being late. When you turn 65 is one of those. When you lose employer insurance and you're beyond age 65, as long as you had that employer insurance, you were not required to take Medicare. But once you lose that employer insurance, that's your window where you can now sign up for Medicare at that moment, not waiting until January 1, not getting penalized for being late. COBRA ending is not an opportunity to sign up for Medicare immediately and without penalty. That's based on when you lose your employer coverage initially. My husband and I ran into this. He got laid off. His company was going to pay COBRA from May to October. I was a federal employee, or at least my insurance was on the federal year. So July 1 was my end of my open enrollment period. He was losing his job in May. That would have triggered, that was a life event. I could have enrolled him right then. But if we waited until October when the company stopped subsidizing his COBRA, we would have to wait until the following 1st of July for me to add him to my insurance. Okay, so don't let COBRA lure you into thinking that you don't need to do anything about Medicare if you're already Medicare age. Okay, flexible spending accounts. How many of you have or have used flexible spending accounts at an employer? Okay, again, not as many of you as I expected, so I'll try to make this fairly quick. If you signed up for a flexible spending account for this year and you get laid off mid-year, you've only put in part of the money that you agreed to put in over the course of the year. But legally, you can still file expenses. You can still file for reimbursement of qualifying expenses for the total amount that you would have contributed had you worked through the end of the year. So maybe this is for child and dependent care. Maybe you had, over the course of the year, you would have put in $4,000. At this point, you've only put in $2,000. If you already have $4,000 of child care expenses, you can request reimbursement for the entire $4,000, even though you have not put that amount in there. It's quirky, but this is what the law says. I want you to know what your rights are, so that's why it's here. Do check with your employer about the deadline for submitting the receipts. As soon as you lose your job, file for unemployment. Make sure you are ready to get the first check that you're eligible for. But know that unemployment benefits are taxable income. It's kind of like a little salt in the wound there. Okay, investing in uncertain times. I say this kind of facetiously, but this is my take on this. What makes a good investor? Discipline. Okay, I'll go with that. The thing that discipline tells you is that it's unemotional. You've got a plan. You know what you're going to do. Remember I said at the beginning that when we go through financial shocks or any other kind of trauma, our judgment becomes not so good. Our emotions may tend to rule us more than usual, which means that you may be the same person as you were before the layoff or whatever hit you, but your decision-making ability will be different. And so you might make stupid financial decisions. You might make stupid investment decisions, especially if you're doing it off the cuff. So my suggestion is, whenever you're investing, not just in uncertain times, have strategies in place that take the emotion out of the decision. So you've heard these phrases before. Asset allocation is how you decide how much money you should have in stocks, bonds, and cash based on your age and other factors. That probably shouldn't change very much, even if your financial circumstances change. If you've been dollar cost averaging by putting money out of your paycheck into your retirement plan, you've been using a very smart investment strategy there. You should keep doing that if at all possible. You should watch the balance in your asset allocation. If stocks become too big of a portion of your investments and bonds have become too little, you want to bring that back into the range of where you intended for it to be so that you're not taking on more risk than possible. These are not strategies you use just when things are uncertain. These are the kinds of strategies that you use on an ongoing basis to manage risk and keep things where you want them to be. Another way to take the emotions out of it is that you use investments that take very little monitoring, such as index mutual funds or target date retirement funds. I've got links, I think, on the website for you to read more about those strategies. It's a little beyond tonight. But never forget that there's a difference between savings and investing. Money that you need in the short term, and depending on who you ask, short term might mean less than 5 years. Short-term money should be saved and not invested. Because over the short haul, you don't know what stocks and other types of investments like that are going to do. Over the long haul, you have pretty good expectation that it will go up, but it's not a smooth ride, right? You've certainly seen that over the last year. So you're saving for a vacation next year, you're saving for college starting in 2 years, you're building up your emergency fund that you don't know when you'll need. That's savings. That means savings accounts, CDs, money market accounts, maybe very short-term bond funds, not stocks and not other sophisticated investments. When things are so uncertain, you're going to be tempted to time time the market, you're going to think, oh my gosh, everything is so horrible now. There's no way I could put more money in my 401k because everything could just drop next month. I just can't do it now. And so you stop your contributions, and next month, they didn't drop, it all went up. And you're like, dang, I should have kept going there. So don't try to predict what's going to happen. Follow your strategy. And don't be checking the performance of your investments every day. I finally got my husband to stop telling me, oh, the market did such and such today. I'm like, stop looking. We're not going to make any knee-jerk decisions here, all right? We've got a plan in place. And avoid panic selling. The whole point of having an appropriate allocation between stocks, bonds, and cash is you're in a position where you don't have to panic and you can wait it out. If you sell because you're scared, very likely you're selling at the wrong time. So we don't want you to get that scared. We want you to have your investments set up so that you might get a little concerned, but you know that you've got cash, and then you've got bonds that if you needed money, you could tap those. You don't necessarily have to sell your stocks while they're down. Avoid panic selling. I don't really buy into the idea of a silver lining. Every cloud has a silver lining, but there are some silver linings to drops in the stock market, and these are those. If you've been thinking about making a conversion from traditional retirement plan into a Roth, when values drop, and you were going to do it this year anyway, have at it. Because you're converting the same number of shares, it's just that they're on sale right now. And so you pay less tax on the conversion. And with your retirement plan contributions, when the values of the things that you're putting your money in your retirement plan, when the values drop, well then this month your contribution buys more. It's kind of like going in the grocery store and seeing that green beans are 50 cents a can today, one day only. Well, hey, my $5 will buy 10 cans. Instead of if I wait till next week, my $5 will only buy 4 cans. So think of your contributions in your retirement plan the same way. When prices are down, go, yes, I'm going to buy a lot more today. And then when it goes up down the road, say, yep, see how good of an investor I was? I was just doing dollar cost averaging. All right, you're good. Nobody went to sleep through all of that. Like I said, these are so many unrelated ideas just pulled together by the same concept that when things aren't going well, we have to look everywhere to try to figure out what's going to work to help us through it. You were very good about holding your questions. So the official part of the presentation is over. I see that Angela is ready with the microphone for questions. And so if you got a question, throw up your hand. Wait till Angela brings you the mic, and we will take questions. Yeah, and she's coming.
Thank you. I have 3,000 questions.
We can't do all of those tonight.
Okay. When you're talking about your spreadsheet and keeping track of what your expenses are, some credit cards send you a listing of those. Is that in your estimation adequate?
So okay. Adequate meaning, do you know what your money went for? You can probably tell because it's going to tell you the retailer, for example. So if it says Jewel, that was groceries, and if it was Lowe's or Home Depot, you figure that was some kind of home improvement or something. So yeah, for many purposes, that may be totally fine. But like my sister buys a lot of stuff on Amazon, and she sees that the retailer was Amazon, and she has no clue what that was. Was that a gift for the kids? Was it groceries? Was it her reorder on paper products? So it depends. It depends on whether that's detailed enough or not.
So no.
It depends.
Oh, okay.
Yeah. You may not realize whether it's detailed enough until you start pulling your information together. Okay. Anybody else while she's looking for her other question? Can we?
When you're laid off, I thought you have, if you qualify for Medicare, you have 8 months, is it, to file then? or to join?
Okay, if
Oh,
you
yeah.
had, if you had insurance with your employer
Right.
and you're laid off, you're right, there is a window, and I think you're right. I think it's 8 months. It doesn't mean you have to wait 8 months. You shouldn't, because the last thing you want is to have a period of uninsured,
Right.
So you would want to sign up and get the
reason
transition.
being is I have HSA and I don't,
Okay,
That's why.
HSAs, yes, okay, HSAs and signing up for Medicare, kind of a little
Yeah,
conflict there.
it's a-
You cannot contribute to an HSA at the same time that you have Medicare. Medicare Part A, if you're past age 65, when you sign up for Medicare Part A, it is effective 6 months retroactively.
right,
And so you are correct, that is one situation where
the 8 months grace
you
period
might
is-
want to wait until 6 months out.
Yep.
Yeah, because you had just contributed to the HSA in that last month of work. Great question.
Okay, good.
Yeah, great question, yes.
That helps. Oh, I'm sorry.
That's only number 2. So when you're talking about what happens if you don't pay, recently, one of my longtime cards switched to a somebody else card. And I called and left a message and told them to cancel the card. They didn't. And now they're charging me a late fee and saying that I didn't pay. So when I call them, can I ask them to reverse the late fee and also not report it?
Yes, you can always ask. You can't guarantee that they will agree. But in this case, you have a stronger reason than normal. You will say, I left, and I hope you have a record, I called you and left a message on this date, to cancel the card. And so that should help your case. But if you have a good payment with them in the payment history in the past, odds are that, yes, they'll waive the late fee, maybe waive the interest that might have been added on that. So when you asked them to close the card, you were closing with a balance that you had yet to pay off, I presume.
Yeah,
Okay.
yeah.
Because if you had no balance, there couldn't be a late fee. So that's why I just
Okay.
wanted to clarify, yeah.
But then if you do have a month's non-payment reported, how much does it affect your credit rating?
A single month of 30 days late, it will have an effect. It probably depends on how strong your credit report overall is.
800.
If you have like 6 credit cards and they're all paid on time for the whole 7 years that are reported, and this is the only late one on there, a few points. But if this is your only card and you're late on that, then you don't have a very thick file and the impact will be greater. And the more late it is, the worse it is. If it's 60 days late, that's a bigger hit. If it's 90 days late, that's a bigger hit.
Okay,
So well worth asking them to not report it. Yeah.
okay. Give somebody else. a
Anybody
try
else?
now.
Yeah.
Anyone else? Oh,
Do you still teach the curriculum that you mentioned in the beginning when you work with the townships?
I don't, and it's not in publication currently. I'm pretty sure they sold out all the stock. They used to actually have where you could download the files and print yourself. If you want me to check on that for you, because I'm sorry, I'm not 100% sure. On my webpage is a Contact Karen tab. Go in there and say, Karen, can I get a copy of All My Money? That's the title, All My Money, and I'll look into that for you. You're welcome. Okay, going once. Wait for the mic.
Oh, I'm sorry, for the recording.
Do you have any advice on if a person in the 22-year-old age group,
I'm sorry.
in the 22-year age group or
Okay.
whatever, was away at college and didn't pay the tuition for a semester, so they won't release transcripts, and so it's gone to collections and the interest rate's going up? Is there any kind of advice for negotiating a settlement
Negotiating with a college for non-payment of tuition.
for a semester?
Okay, I have to be very honest. I have never dealt with that. I've never read recommendations about that. Somebody else in the group may have experience and be able to suggest, but other than treating them like any other creditor,
Right.
I have no
Because I've
idea.
heard before that the longer you've gone without paying, like medical debt too, that there's ways to negotiate, because they'd rather get something than nothing.
Oh, okay, let me make a comment about that. There are certain advertisements that I absolutely cringe at. And one of them is, I haven't heard it recently, but I used to hear it when I was commuting a lot, that, oh, we'll help you get out of debt, we'll make sure that your lenders settle with you for pennies on the dollar and blah, 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 blah. Well, when Consumer Reports investigated them, their whole plan was they told you to stop paying until the lender got desperate enough that they would negotiate. But by that point, I'm sorry, when you started working with them, maybe you were 2 months late. Now you're a year late, and I'm sorry, it's going to take you 7 years to get a decent credit report back. So the idea of delaying in order to make that a strategy for negotiating, I'm very leery of that. That was their whole business model, and it stank. Okay, to be
Thank you.
very, very blunt. One more over here. And we're going to call official quits to questions at 8:30, but I will hang around for a bit after if anybody else has.
Just one really quick clarification. When you were talking about tax deferred account distributions, you were mentioning for employer plans, when there's a withdrawal, there's by default an automatic 20% withholding for
Yeah.
federal. Is
Yeah.
that are you referring to like employer 401k plans?
Yes, any employer plan like that, 401k, 403b, 457, probably, I don't know if that applies to employer IRA plans like Simples and SEPs. He's saying no. I've got a knowledgeable person in the back here I can check with. So, yeah, so that's that, and that is fixed. If it's an IRA, the default is 10%, but you can request it to be 0, you can request it to be 20, but with employer plans, that's what they have to do.
20.
Yep.
And that's for federal?
Yes.
Okay,
Yep.
thank you.
Yep, you're welcome.
Great presentation,
Oh,
thank you.
thank you. So appreciate you all coming out tonight on this lovely day and spending your evening with us.